Materiality principle. Now, what do you mean by material? I think most of you must be aware, right? If not, let me explain this to you. Material means something which is relevant or significant, something which is having importance. While these may not actually necessarily fit in with the technical jargons that are pronounced by various committees, but to give you an idea of what is material, you need to understand one thing. We know that whatever financial statements are prepared, or rather the books of accounts which are prepared, are meant for various stakeholders. Okay? The stakeholders could be shareholders in case of a company, right? The investors, people who want to invest in the company, the lenders, which could be the banks, and all these things. The idea behind a materiality principle is something, if there is any information, okay, which can impact the decision making, information which impacts what? Decision making. Of the lenders or of the stakeholders is what is important. Okay? Now, materiality is a relative concept. What do you mean by that? Relative means depends on the size of the company, right? The nature of item. Let me just explain these to you. A company which has a turnover of 1000 crores, which is basically equal to 10,000 millions, okay? An item of, let's say, 10 million may not be very significant for them or material for them, right? Material? Question mark? No. Whereas if a company has a turnover of 10 crores or 100 million, for them the same number is relevant. So depending on the size of the company, one can take a call as to whether an item of expenditure, income, or any other financial transaction is material to that company or not. Second is the nature of item. Okay? So let's say, for example, for the same company which was having a 1000 crore transaction, 10 million was not important because it was small. Okay? But let's say this 10 million is a damage paid on account of fraud. Now this is very significant and material from the perspective of these stakeholders. This basically shows that the management has done some wrong act for the company, right? So next time when the lenders want to lend out the money to the company, they will be very wary of lending to a company which is doing fraud. So even though the amount remains the same, which is 10 million, it becomes material given that the nature of this 10 million was something which is important and gives useful information to the stakeholders. Right? So materiality principle has to be applied on a case-to-case basis. Size of the company, the nature of expense or operations is important, and all these factors have to be taken into account to determine materiality. What is material for one company may not be material for another one, or what is material for the second company may not be material for the first one, and vice versa. Right? The nature of the item plays a very important role in determining the materiality principle. Wherever an item is material, normally from an accountant's point of view, these are given by way of disclosure in financial statements. Okay? So that's all about materiality principle. This is Arinjay Jain. Okay? If you like this video, please hit the like button. It doesn't cost anything, right? And if you want to share and help us create an educated world, please do that by clicking the share button below the video lecture, whether it's on YouTube or on our website. In both the cases, you have these two options. Thank you for your support, and we look forward to many more such lectures in the future.